Welcome to this explainer. I'll be stepping in today as your California real estate advisor. If you're looking at condos or townhomes in today's market, you are absolutely going to deal with a homeowners association or HOA. Now, my role here isn't to sell you anything at all, it's to protect you from expensive mistakes. Over the years, I've seen deals completely fall apart and buyers face massive, unexpected bills simply because they didn't really understand what they were buying into. So, let's make sure you have the facts to move forward with complete confidence.
Most buyers think they're simply buying a condo or townhome, but in an HOA community, they're also buying into shared financial responsibility. Let me be really clear right up front. An HOA transaction is, fundamentally, a risk management transaction. You aren't just buying four walls and a roof. You're actively buying into a community's reserve funding, their insurance exposure, their maintenance obligations, and ultimately, their future risks.
Here is where the confusion usually starts. The assumption for most buyers is simply, well, I can afford the mortgage and the $400 monthly HOA fee, so I'm good to go. But the reality goes much deeper. That monthly fee, it's just the surface layer. Beneath it is shared financial risk, heavy insurance exposure, and the very real possibility of future assessments. The HOA fee is really only one piece of the picture.
To ensure you make a fully informed decision, here is our preparation roadmap. 1. Beyond the monthly fee. 2. The truth in the documents. 3. California insurance and financing risks. 4. Balconies and deferred maintenance. And 5. Avoiding escrow surprises. We're going to logically peel back the layers of this process together.
Okay, let's dive into this with Section 1. Beyond the monthly fee, understanding ownership structure.
When you buy into a common interest development, the entire concept of what you actually own changes completely. Buyers often operate under a very simple assumption. If I use it, I own it. But legally, in an HOA, that just isn't true. You typically only own the interior airspace, the walls-in area. Meanwhile, the HOA owns or maintains the big-ticket items, things like roofs, exterior walls, plumbing, and elevators. Legally, ownership and maintenance responsibilities are determined strictly by the condo plan and the CCRs. You are completely financially dependent on how responsibly the board handles the maintenance of those massive exterior and structural elements.
Moving right along to Section 2, the truth in the documents, financial health and reserves. Once you enter escrow, you'll receive a large package of HOA documents. These are the most critical tools you have to uncover the hidden financial realities of the community before it's too late. A vital piece of this package is the reserve study. In California, this is a legally required report. It estimates future repairs, calculates the useful life of major components, and projects the association's funding needs. Basically, it tells you if the HOA has enough savings to fix things when they inevitably break. I always remind my clients, no current assessment absolutely does not mean no future risk. Let me ground this in a real Bay Area scenario for you. Imagine reading through a reserve study and discovering that a community-wide roof replacement is required in 2 years. The estimated cost? $1.2 million. But when you check the association's bank accounts, they only have $200,000 saved up. They're short $1 million. So where does that missing $1 million come from? Well, it comes directly out of the owner's pockets.
And that exact scenario leads us right to a special assessment. A special assessment is an extra charge billed to owners, completely beyond normal monthly dues, to cover unexpected repairs, severe reserve shortages, or massive insurance costs. Now, we discuss this calmly because knowing why special assessments happen prevents fear. When we review the documents, we're simply checking the math to ensure the community is properly funded to avoid these kinds of shocks.
To put this into perspective, in some older San Francisco high-rises, special assessments for deferred maintenance or state-mandated fire safety upgrades have been known to exceed $50,000 per owner. That is a life-altering expense for most people. This is exactly why understanding the documents protects buyers and sellers alike.
That brings us to Section 3, California insurance and financing risks.
Let's shift our focus to the external hurdles affecting the market. Right now, one of the absolute biggest threats to affordability in an HOA is the widespread California insurance crisis. The landscape is incredibly volatile. Rising premiums, non-renewals, reduced coverage, and massive deductibles are severely impacting California HOAs. When an HOA's master insurance policy goes up, that cost is passed directly to you through increased monthly dues. And that directly impacts your personal debt-to-income ratio, which can suddenly put your own financing at risk. And this brilliantly illustrates just how fast these costs can rise. Take San Francisco, for example.
In 2019, the average Metro HOA fee was around $360 a month. By 2025, that jumped to $502 a month. These hidden long-term ownership costs have drastically increased over a very short period, largely driven by insurance and inflation.
Because of these exact financial strains, condo financing is completely different from single-family financing. There are two distinct steps here. Step 1 is buyer qualification. That's your personal credit and income. But step 2 is project qualification. The lender will send a detailed questionnaire to the HOA. Even if you are a flawless buyer on paper, the lender can and will reject the loan if the project itself fails their risk assessment.
Here's what lenders are actually looking for. Entities like Fannie Mae and Freddie Mac heavily scrutinize underfunded reserves, any unsafe conditions, deferred maintenance, and the specifics of the master insurance policy. Lender expectations regarding reserves are becoming incredibly strict right now. If an HOA is underfunded, the project can become what's called non-warrantable, which means traditional financing is pulled and escrow just grinds to a halt.
Let's take a look at Section 4, balconies and deferred maintenance.
Looking closely at structural risk, specifically elevated structures, California law takes structural integrity very seriously. Under Civil Code Section 5550, reserve study inspections are required every 3 years. Furthermore, as we approach 2026, expanded disclosure rules will mandate specific inspections for elevated elements like balconies, decks, and walkways. Older condo projects with deferred maintenance may be facing massive repair costs in the near future. This is something we actively look for in the disclosures.
Which leads us to our final part, Section 5, avoiding expensive escrow surprises. So the crucial point is knowing how to spot the red flags. A smooth, successful escrow always starts with understanding the HOA early in the process. These red flags include low reserves, high delinquency rates among owners, insurance non-renewals, structural concerns, pending litigation, or even incomplete HOA documents. Seeing a red flag doesn't automatically kill a deal, but it does mean we pause and conduct a much deeper investigation. We don't guess, we verify. Before you remove your contingencies and commit your hard-earned funds, these are the essential questions you absolutely must be able to answer. Are the reserves healthy? Are there pending assessments being discussed in the meeting minutes? What exactly does the master insurance cover, and is there any active litigation?
And this is exactly why you have a professional advisor in your corner. A strong real estate advisor helps clients identify these risks early, coordinates seamlessly with escrow, and navigates strict lender timelines. We protect our clients by reviewing these timelines carefully, reading the fine print, and never ignoring the tough HOA issues just to push a deal forward.
Here's how buyers often get surprised later. They operate on the assumption, oh, the lender will catch everything. But the reality is entirely different. We must review all HOA documents ourselves before removing contingencies. The lender is protecting their loan. We are protecting your long-term financial health. Relying solely on the lender is a recipe for a very expensive mistake.
Let's move to our closing thoughts and see how this builds your confidence. Because in today's California market, understanding the HOA can make the difference between a smooth escrow and a very expensive surprise later. Buying into an HOA is not just about the unit itself. It is about the financial and structural health of the entire community.
Which brings me to the core philosophy of our work together. The goal is not fear. The goal is preparation. HOA issues are highly manageable when identified early. When you know what questions to ask and what documents to review, you take control of the transaction. You can avoid surprises and you can feel completely confident buying or selling your property. Thank you so much for joining me for this explainer. Keep this information handy and ask the right questions. Before you sign your next offer, I want you to ask yourself, what hidden details are lurking in the documents of your next potential home?